We're going to go ahead and get ready to start. Hello, everyone. My name is Cesar Placencia. I'm the Public Affairs Officer here at Clearinghouse CDFI, and I'd like to introduce to you the rest of my team. There is Annie Norwood, Director of Lending, Christy Ollendorf, Chief Credit Officer, and Tricia Hansen-Horn, Director of Impact. These are Clearinghouse's 5 C's of credit. Before we begin, we'd like to ask if you have any questions to please place them in the Q&A, and we'll make sure to answer those at the end of the webinar. We'll also be recording this webinar for training and future use. Our company is privileged today to bring the 5 C's of credit to you. For those who are not familiar with Clearinghouse CDFI, let me take a moment to acquaint you more closely with who we are and what drives us. Clearinghouse Community Development Financial Institution, or Clearinghouse CDFI, is a full-service direct lender financing projects that create jobs and services to help people work, live, dream, grow, and thrive in healthy communities. The company was established in 1996 to serve low-income and disadvantaged communities in Southern California. Since then, Clearinghouse CDFI has expanded its service area to address unmet credit needs throughout the U.S. and Indian country. Here's where I believe we differ from other lenders and how Clearinghouse CDFI is able to be impactful with our lending. Clearinghouse CDFI, our vision is to ensure equal access to credit for all neighborhoods embracing any income level and ethnicities. We are dedicated to identifying creditworthy borrowers who projects foster community assets by meticulously evaluating each applicant's repayment ability and analyzing each loan application on an individual basis. We strive to make every loan a tangible benefit to the community. And our mission is to provide economic opportunities and improve the quality of life for lower income individuals and communities through innovative and affordable financing that is unavailable in conventional market. And before we move on, we're just gonna try to gauge who's in the audience right now. Some questions should be popping up. Some polling questions should be appearing on your screen shortly. We're gonna give everybody about 20 to 30 seconds to go ahead and answer those. So if you could just give us just a good gauge of who's in the audience right now. Those answers will generate, and then we'll see who's out here. And thank you so very much for taking time out of your day for joining our webinar. Okay. And we're gonna spin about 30 seconds, and we're gonna generate those answers. Okay, we got a good equal mix of everyone across the board here. Well, no matter what type of organization you're here representing, I feel you're going to get some useful information out of this webinar. And the 5 C's of credit matter for at least 2 reasons, and here they are. The 5 C's of credit is a set of criteria used by lenders to evaluate the creditworthiness of potential borrowers. Understanding these criteria helps organizations prepare for credit applications and improve their chances of obtaining financing. Think of it like this. For some of you, graduation is coming up this December. Now, you're going to be preparing a senior packet, right? The more your packet has that's completed and correct, the more likely a college is likely to look at you. The less prepared your packet is and the less complete the items inside your packet are, the more likely a college will pass on you. So that's somewhat the same when applying for a loan with a financial institution. The 5 C's we are talking about are collateral, capital, capacity, character, and conditions. Let's first walk through the brief yet powerful definitions that Clearinghouse CDFI has put together for each one. Collateral is an asset pledged by the prospective borrower to secure the loan. Capital is the amount of money invested in the project or commercial real estate being considered. Capacity is the prospective borrower's ability to repay the loan based on its income and existing debt. Character refers to the prospective borrower's reputation and track record for repaying debt. And conditions refers to economic environment and industry trends. Knowing the 5 C's of credit is important. So too is taking a deeper dive into what each one involves. Collateral is what is offered by the borrower to secure a loan. From another perspective, it's what lenders can take if the borrower defaults on their loan. So how lenders can secure loans with borrower assets? Well, cash flow is almost always the primary source of the loan repayment. The lenders also look at a secondary source of repayment. And excuse me, I think we are on the wrong slide. Can we go back a slide to collateral? There we go. Excuse us. Collateral represents assets that prospective borrowers pledge as an alternative repayment source for a loan. Most collateral is in the form of hard assets or real estate and equipment. With collateral, there are 2 types of lending. There's unsecure and secure lending. Secure lending is when collateral is offered, which means the borrower is pledging real estate. In our case, we secure real estate as collateral for our loan. Loan to value or LTV is always a consideration. The lower the LTV, the better pricing and consideration for lending. This reminds me a little bit about a pawn shop, and then this might strike with some people and might not. Okay, where you bring in your property, and in this case, real estate, and you're given about pennies to the dollar for your property. That could be 30 to 40% of value. Clearinghouse CDFI lends a maximum of up to 80% on LTV for real estate. But please remember the value of the property or the real estate pledged to the loan is a primary consideration to the lender. Also of high importance to the loan is capital. Next slide, please. There we go. As I mentioned before, we are a real estate secured lender, and excuse me, we're a real estate secured lender. We lend to a wide variety of borrowers. To do this, we consider the following. How well capitalized is the prospective borrower? How much money has the prospective borrower invested? How much money does the prospective borrower or guarantor have? Will the prospective borrower be prepared to add more of their own money, if the organization's cash flow can't service the debt? Can a guarantor's personal resources support the organization if needed? Lenders often want to see that the prospective borrower has a financial commitment and a financial stake in its success. You know the old saying, skin in the game? This is what we mean. A lender feels more at ease if they see that they are lending to an organization where said organization's guarantors are investing their own capital. The prospective borrower's financial statements and or guarantor's personal credit are keys to the capital question. What I mean by that is when credit is evaluated, it is done both as an organization and as an individual. When collateral and capital are clearly identified, we also work with the borrower to establish how much debt or additional debt is a viable business move. And which takes us to capacity. Debt service coverage ratio, or DSCR. How much debt should a prospective borrower carry based on net income? Traditional lenders prefer over 1.25. High-risk lenders can go as high as 1.45. At Clearinghouse CDFI, we look at DSCR of at least 1.10, but preferably 1.15 or above for commercial real estate lending. Think of DSCR or debt service coverage ratio like your paycheck and your bills. If you're making $5,000 a month on your paycheck and your loan payments are $4,000 a month, you have more income to cover your debt. That's DSCR. The higher the number, the more comfortably you can afford the payments. If the number is below 1, like a 0.90, it means you're not making enough to fully cover what you owe. Increased capacity. Prospective borrowers can increase capacity by paying off or paying down debt or making more money. This is obviously true, right? If you make more money, you can afford to make a higher monthly payment or pay off your loan sooner, or better yet, pay off or pay down, especially debt with higher interest rate. If you do that, that gives you increased capacity. That's a better chance to be lent to. And industry patterns. Become familiar with the expected pattern in your industry. Some industries can take a higher debt load. Others may operate with less liquidity. The character of the borrower is less tangible than collateral and capital, but is no less important. It basically answers the question of, will the borrower attempt to pay when they can and when they can't? And character. What is the character of the management of the prospective borrower's organization? Does the prospective borrower's organization have a credit profile? Believe it or not, your organization has a reputation within your own industry. Sometimes it's not just a credit report that may give insight on whether or not an organization is able to pay back a loan. What is management's reputation and track record in the industry and the community? A credit report is supposed to provide an insight into one's financial management history. It's a snapshot of one's credit rating. And by snapshot, we mean at the moment they're making a request for the loan. For our purpose, items on a credit report can run decades, but current debt is the most reliable indicator of future debt payments. If there's a false reporting or you see something incorrect on your credit report, dispute it. It is solely your responsibility to monitor and correct your credit report, so do so. Last but not least, we must consider the conditions in which the borrower does and will exist. And that brings us to conditions. Economic conditions. What are the conditions? What are the current economic conditions, and how does your organization fit in? How long has the business been open? Macroeconomic conditions. Will your organization continue to grow? Industry trends. What are the trends for your industry, and how does your organization fit within them? This brings up a good little story. COVID, right? Who was ready for COVID? Hands? Anybody? I think none of us were. None of us were ready for COVID. These are industry trends that we're talking about, or just economic trends. When COVID hit, no one knew what to do. Everyone was scrambling, running around. A lot of businesses fell by the side. Some businesses were able to pivot with help and restructure, and they're doing just fine now. But these are one of the conditions that we're talking about. And the fact that COVID just happened about 5 years ago is still kind of in the back of everyone's head. And this is something that people will look at. This is something that lenders will look at. As we consider the first 4 C's of credit, collateral, capital, capacity, and character, we also view the entire opportunity to lend from another lens. Conditions. It's a lens that allows Clearinghouse CDFI to consider other conditions impacting the loan decision process. Other considerations. Lenders will not give equal weight to the 5 C's. One weak area might be offset by other strengths. To me, the top 2 would always be collateral and capital. Each loan is like a snowflake. There are no 2 alike. They might have similarities, right? Oh, this a restaurant, that's a restaurant. It's a warehouse, it's a warehouse. But in the details lie the differences. But remember, you are the biggest element. I've alluded to what makes Clearinghouse CDFI different from traditional banks, but it's worth to spend a bit of time outlining those differences. We have more of a flexible loan structure. We can have a longer interest payment period, longer amortization period, lower debt service coverage. When you're working with Clearinghouse CDFI, you're working directly with the decision maker. You're working with the chief credit officer, you're working with the director of lending, and they're great team. We have a wide and deep experience to ascertain risk and understand the prospective borrower. We're able to fund complicated deals consistent with our mission. Our goal is to qualify loans and not to deny loans. We do have a loan committee, but by that time, your file has gotten to the point and it's been well vetted by Christy and her team, and all the real tough questions have been answered and the situations have been answered where you pretty much have an idea of what the answer is going to be. And now we're going to go to our question and answers part of our webinar. If you have any questions and need some answers, please go ahead and put them in the Q&A. We're going to have our lovely director of lending here, Annie Norwood, hop on and field some of those questions. Annie?
Okay, I see first few questions in the chat in the Q&A. The first one is business credit more important than personal credit when applying for commercial property financing, or do they hold equal weight for lenders?
That's a great question. At Clearinghouse CDFI, I would say we look at both. We consider both the business credit and the personal credit. But the primary thing we're going to focus on is the business credit, the project itself. We want to make sure the project that you're proposing financing for can stand on its own. Of course, we will also look at the sponsor's personal credit. If anything pops up on that, like a red flag of any sort, we are going to want a letter of explanation from the borrower. And so we'll take into account both, but I would say largely we're focused on the business. And then, like I said, we just would want an explanation and an understanding of any personal issues that might pop up.
Question and Q&A. I want to purchase a second location for my business. How do lenders evaluate my existing debt and credit when deciding to extend additional financing?
Another great question. Of course, we love to see businesses growing, and something as a CDFI we always want to support. So we help the expansion of businesses all the time. The way that we're going to look at this is we're going to want to see the finances for your first location and really understand that business. And then kind of look at that and compare it to the projections for your new location and look at the market for that new location and make sure there's demand for that. And so we'll just align what you're doing at your first location and how that correlates to your second location to make sure it makes business sense. And then, if it all looks great, we would be, happy to support a second, third, fourth location.
We have quite a few questions. The next one is, will my credit history influence my specific loan terms, length, down payment requirements, etc.?
Another good question. Your credit history, definitely could influence your the terms of your loan. There are certain terms that are more based on the property type and or the needs of the borrower. Like the term of the loan, the length of the loan is generally going to be set on the needs of the borrower, the source of repayment, the plan for that property. Are they going to refi in 2 years, or do they plan to hold on to it for a longer period of time? It's also based on property type. For housing, we usually can do a longer term than we can for other types of properties, such as offices or retail. Those are typically going to have a shorter term. But down payment requirements, that can change based on credit history, other aspects of the deal. If there is something that's tight, like debt service coverage is tight, or there's some kind of credit history issue, we might want the borrower to come in with just a little bit more upfront to mitigate some of those risks when it comes to personal credit.
The next one, what is the company's current appetite? What are you guys lending right now? What rate are you guys offering?
Great question. It's a real moving target as far as rates. We all know rates are changing, but we are seeing, gratefully, our cost of funds are coming down. So our rates are coming down a little bit as well. We are lending in all areas. We're, lending across the board in housing, religious institutions, church or offices, retail. We're doing all different types of lending still. We've never really pulled back on any one particular type. Our rates right now are in the 8 to 9% for perm loans, and they're around 10% plus or minus 0.5% for construction. But those are moving targets. So I would encourage anyone on here, if you do have a loan and you want a real understanding of our rates, to reach out to someone on our team, and they can quickly give you a pulse as to where we currently are on rates.
Jenny, the next one is a long one. Does your organization provide lending for first-time real estate development projects?
Oh, so the first time, so I guess we'd want to see the person that's doing it, the sponsor, has some experience doing something very similar to this. There are situations where the sponsor doesn't have experience, but they're partnering with someone who has very extensive experience, and sometimes we can get on board with that. But I would say we steer away from true startups, someone who's never done it before. This is their first go. Unfortunately, that is not in our wheelhouse. We just don't really finance the startup type of business or operation. But if someone's able to partner in a meaningful way with someone who has experience, we can get on board with that.
Wonderful. This participant provides a little bit more detail about this project. Our team is engaged with an opportunity to build affordable townhomes.
Yeah, I mean, I think I think for that situation, I would suggest reaching out to our team, and we can talk through the specifics of that project with you. One of the benefits of our team is we're small and we're available. We're very accessible. So if you reach out to us, you will get a human being, one of our business development officers, who can respond to you, within a couple days and get on the phone with you to talk through the deal.
Next one, does the organization provide funding for the purchase of single-family homes and that will be rented out at affordable rates, specifically 80 to 120% AMI, area median income?
Yes, we have not done a ton of single family home rentals, but it's definitely something we consider. We have done it before, so I would encourage you, to reach out. We'd be happy to talk to you about that. And we do a lot of affordable housing as well.
Browsing through the questions. Besides lending itself, how do you support brokers, make their job easier, help them close more business?
It's a good question. We've our work with brokers has ramped up a lot in the last, I'd say 3 years. So we're pretty experienced working with brokers now. As I spoke to earlier, I think one of the benefits of working with us is we are a relatively small team and we're pretty nimble. We are solutions oriented, so we're able to work with you and talk to your borrower about what their real needs are, and kind of pinpoint, if they're wanting a long-term loan, if that's the key term they're wanting to target, we can structure the loan around that so that it mitigates risk to a level where we get comfortable with the deal, but it satisfies the needs of the borrower. I also would say that you have access to everyone on our credit team. You're working with a business development officer in the beginning, you'll have access to them throughout the entire process, but you also have access to me as the director of lender, our chief credit officer, our underwriters, our processors. So you're in close contact with our entire credit team from start to finish.
Yeah, another question. I'm about to start a construction project and I'm thinking of using my cash to start the project and then we'll seek financing. if or when I run out of cash? Is that okay?
That is a really good question. I've seen this a lot in my career, where people start a project thinking they can use their cash to complete it, and then during the project you run out of money. That I would highly discourage people from going this route, because the problem there is if you run out of money and then you need to go get a bank loan, most banks are not going to want to lend to you if you have no cash reserves. So it's always my advice to keep those reserves in place, and go to a lender up front to complete the project so that you don't get stuck in the middle. Another issue with starting a loan request mid-construction is, that can lead to title issues. A lot of lenders don't get comfortable with that and don't want to start a loan in the middle of construction. Sometimes you can work around that, and we have. And at Clearinghouse, we're able to do it sometimes, but it's always cleaner and safer as a developer to get a loan up front. And then, hold on to that cash should you need it for cost overruns or for operating reserves.
Thank you. The next one, and maybe the last one, to be mindful of time. On average, how long does it take to get a decision on my loan application with Clearinghouse CDFI?
So this is, I would again advise for every loan that you come to and speak to a BDO before the request to get a sense of how long it'll take, because this really depends on volume. At Clearinghouse CDFI, we have a small team. So sometimes when we get inundated with deals, we do take a little bit longer, but, I would say that the pipeline is, normally it takes between 30 and 75 days, which is pretty efficient. All things considered, but it just really depends on the deal type, our volume. But if you do reach out to us, we can give you a pretty good pulse as to how long we think it will take for that specific loan. And also it depends on how responsive the borrower is. Sometimes you're dealing with a less sophisticated borrower and it just takes a little bit more time to get all the information together, which is okay. We're happy to walk through that process with them. Or other times you have the whole loan packet buttoned up and ready to go. I will say, one thing that can help you make the process more efficient and move faster on our end is having everything buttoned up, having a really solid executive summary, coming to us with, sources and uses tied up. If you have questions, reaching out to us and we can help you clean up some of that stuff. For construction loans, we really want it to be shovel ready. We want to see, a full construction budget, a contractor's bid, information on the contractor, kind of permit, ready to pull permits, because we'll need all of that to order an appraisal up front. And if you have all of that ready before reaching out to us, we can move very quickly.
The last few questions. What types of projects does Clearinghouse CDFI not finance?
Well, we are a community development financial institution. So as you can imagine, we do focus on loans that are supporting the community. So supporting underserved communities. So we are doing a lot of affordable housing, lending in underserved locations, developments that would create jobs, grow small businesses, et cetera. The loans that we're not doing are loans that don't kind of check one of those boxes. Examples would be luxury housing. We're not going to do luxury high-rise, apartments or something like that. We also don't do a lot of storage units because they're not creating a lot of jobs, they're not creating housing, that sort of thing. Another thing that we get a lot of requests for that we sometimes cannot do are cash out refis. We can do some level of cash out on loans, but we always want the borrower to maintain about, somewhere in the around 20% for most. Sometimes for nonprofit deals, we can inch that down a little bit, but we want there to be some kind of cash equity into the deal. So we're only willing to cash out to a point where oftentimes people want to cash out based on the imputed value, but just based on, as a CDFI, we only go up to a certain level for cash out lending.
Thank you, Annie, for your insightful answers. And I think we can close with Q&A.
Thank you. Caesar, you're on mute.
Was I on mute? I apologize. Sorry. Okay, here we go. We are going to our next slide, which is we have one more poll. If you don't mind filling it out, we'd like to know what types of subjects you would be interested in learning about at our next webinar, which I believe will be next spring, if I'm not mistaken. So the polls should pop up on your screen. And we're going to give you about 20 to 30 seconds for that. Maybe next time we'll have some elevator music to kind of go with the questions. So I apologize for that, but. Okay, let's see. Okay, thank you. Oh, all right. Looks good. All right, thank you. I appreciate that. Okay, and now we're going to go to the next slide. And well, I want to thank you for attending. If you have any further questions or if you'd like to explore opportunities to work together with Clearinghouse CDFI, please do not hesitate to reach out to us. You can give us a call at 949-859-3600. You can email us at loaninquiries@ccdfi.com. Or you can find us on the World Wide Web at www.ccdfi.com. We have a whole bunch of stuff there. Our impact map is there. Our loan highlights are there, our just fundeds. All of our emails are on there as well. So if you're looking to reach out to any of us, they're going to be on that website. So please visit us. We've come to the end of our webinar. I hope that you were able to learn something new and found the information helpful. We would like to thank all of the staff that's helping us behind the scenes in the webinar here for doing such a great job. And from all of us here at Clearinghouse CDFI, we'd like to wish you a happy upcoming holiday season. I hope you have a great holiday season. We hope to see you next time and have a great rest of your day. Thank you.